The world's largest asset manager, Blackrock, has acquired two major Panama Canal ports for $22.8 billion. This was the price for a 90% stake in ports on both sides of the Panama Canal from Hong Kong-based conglomerate CK Hutchisons Holdings Limited. The deal also includes an 80% stake in other port operations, which span 43 ports across 23 countries. The deal follows BlackRock's $12.5 billion acquisition of Bayo Ogunlesi's global infrastructure partners, which also participated in the transaction. Could the crisis, which we thought was playing out as the US eyed Panama Canal, could it have become an opportunity for a business deal? Hello, welcome to Global Business Insights, where we look deeper at the main business stories. Today we look closer at what could be the largest infrastructure deal in history and how that relates to IMF calling for Nigeria to invest in building welfare institutions. Infrastructure is a huge opportunity area waiting for the boldness and the prodding to attract the investment action that seizes possibilities for high returns, granted there are risks. It took just days for a deal to be mapped out within a few weeks of Trump in office, and tells us that some are paying very close attention to the changing dynamic and acting to realize the opportunities, while others are more frustrated about the threats. But Frank Sixt, co-managing director of CK Hutchisons, said in a statement that the transaction was the result of a rapid, discreet but competitive process in which numerous bids and expressions of interest were received, and wholly unrelated to recent political news reports concerning the Panama ports, with the share price having fallen 40% in the 5 years running up to the deal's announcement. There was an opportunity to offer to major investors seeking value, driven by some of the biggest names in finance in Hong Kong and New York, and it shows that investors are in the wings waiting to dive into exciting opportunities that present themselves. Later, we will look at the infrastructure gap in Nigeria, which is another major opportunity space that the Chinese have been watching and quietly exploiting. This space is awaiting a major investment intervention from the top global players, if the politicians can help remove the obstacles and show openness to the huge investment inflow possibilities. Let's look at other stories making the headlines. The ECB's interest rate decision will take center stage today, along with Lagarde's press conference, where it may be under pressure to push into more accommodative territory as an ongoing trade turmoil raises further concerns on economic growth. Traders see a 98% chance that the European Central Bank will cut its benchmark lending rate by a quarter point to 2.5%, also the sixth reduction since it started lowering borrowing costs in June. US stocks rallied yesterday as Trump announced a one-month auto tariff exemption on Mexico and Canada. The White House delayed by 1 month auto tariffs that could significantly impact US automakers Ford, General Motors and Stellantis, taking their stocks at least 5% higher after the announcement. Also helping sentiment, we got US Institute for Supply Management Services sector PMI, which went up to 53.5 last month from 52.8 in January. Earlier this week, we had the manufacturing sector PMI also in expansion. Price premiums for aluminium on the physical market in the United States have surged to a record high due to the looming threat of tariffs on imports of the metal used in transport, construction, and packaging industries. The U.S. administration is said to be planning to restore 25% tariffs on aluminium imports from March 12. Britain is no more probing Microsoft's partnership with ChatGPT maker OpenAI, concluding that the software giant did not have the level of control that would warrant further investigation. The partnership, which started in 2019 with an initial $1 billion investment by Microsoft, came under antitrust scrutiny in Britain and the US. In the US, with the more market-friendly regulator in the saddle, probes like this are likely to be shut down. US private sector employment data yesterday showed that only 77,000 jobs were added in February. That was much less than the upwardly revised 186,000 jobs in January and less than expected. Also the smallest gain in 7 months. The broader non-farms payroll survey will report their own findings. That's on Friday. According to U.S. Commerce Secretary Howard Lutnick, he's arguing that negative economic data and the recent trend of dropping stock valuations reflect Biden policies and are yet to show consequences of the new team's actions. Still on jobs, the Walt Disney Company is set to lay off more cable channel employees as it prioritizes streaming over other business areas. Volvo is the latest among companies moving more production of some of its models to the US. It says it still aims to stick to a plan to export the European-made EX30 SUV model to the US later this year. Volvo Cars last year moved production of EX30 electric vehicles from China to Europe to avoid European Union tariffs. Higher tariffs by the US causing many to initiate strategic reviews of their business models and supply chain arrangements to minimize any adverse impact. A German court yesterday ruled that Pfizer and its partner BioNTech violated a COVID-19 vaccine patent held by Moderna. The court in the city of Dusseldorf said that Pfizer and BioNTech would have to provide information on earnings derived from the use of the patent and that they owe Moderna appropriate compensation. The ruling is expected to be appealed at a higher court. Saudi Aramco is in the early stage of a potential bid for BP's lubricant business Castrol. Analysts say the deal could be expected to be worth around $6 to $8 billion. In the UK, the Chancellor is looking at several £billion in potential spending cuts to welfare and other government departments ahead of the spring statement. The UK Chancellor Rachel Reeves is scheduled to deliver the spring statement on the 26th of March. This follows expectations that the Chancellor's financial buffers have been significantly eroded by global factors such as trade tariffs, as well as higher inflation and borrowing costs amid tepid growth in the UK. Ghana's inflation rate dropped for the second consecutive month, reaching 23.1% in February, down from 23.5% due to a slowdown in both food and non-food price increases. Food inflation in Ghana has been consistently falling over the past 4 months, but not enough to buck a trend of high inflation driven by several lingering economic pressures. At a time when most are panicking on how to recover costs with all the chatter on tariffs, Apple is thinking of raising volumes by reducing prices. Apple yesterday announced the new MacBook Air models that update the company's best-selling laptop with a faster M4 chip and an upgraded video conferencing camera. The new devices come with a $100 price cut in the US for the 13-inch MacBook Air, which starts at $999. Bringing down prices when others are thinking of raising theirs can be a strategy to build sales volume successfully and increase market share as consumers become much more cost conscious. Gita Gopinath, the IMF's first deputy managing director, has commended the Nigerian government for implementing long overdue measures such as the liberalization of the foreign exchange market and the removal of fuel subsidies. She added that these actions have reignited investor confidence and led to praise from global institutions. She, however, said the toll on the nation's poorest citizens has cast a shadow over the gains, with the poverty rate rising to 47% in 2024. She also said the government needs to rechannel the savings from subsidy removal into social safety nets. The cost of trying to address this scale of intervention has always been the issue, and although there have been attempts at trying to look at it, not enough, in my view, has been done. Instead, borrowing remains a huge burden on the fiscus, and non-investment grade bonds means interest expenses continue to be high. There is no way to get the breakthrough that the IMF is pointing out without serious consideration on the balance sheet and funding issues. For a country where the budget is severely limited by revenue inflows, even with opportunities to improve tax compliance, you still need to think out of the box to find the tens of billions of dollars to transform the welfare space without borrowing an extra dollar. My thoughts are as follows. First, update any prior studies, conduct fresh ones to envision welfare structures and systems, including realistic costs, which ranks with, at least to start with, what obtains in South Africa and Egypt in breadth, coverage and size, and aims over time to match best practice. Second, beyond concessions and other public-private sector partnerships, review possibilities to sell ownership of at least 30% stake in state-owned entities and fast-track the process of implementation, covering at the very least NNPCL, that's National Oil Company, Nigeria Seaports and Nigeria International Airports infrastructure. Third, bring in independent, non-political savvy to work with experienced consultants to conduct and implement an immediate no-nonsense study on cutting total federal government cost of governance by at least 30%. Fourth, implement a radical and expansive welfare safety net and support framework for vulnerable Nigerians based on the roadmap and vision. Reflecting on the recent Panama Ports deal, the sea and airports in Nigeria are vital for the country's economy, but they are underexploited due to a combination of infrastructure deficits, gaps in investment, security issues, and despite ongoing reforms and public-private partnerships, they do not look to be on the path of reaching their full potential. As for NNPCL, we remain self-deluded to think present and future governments will not be perceived as toxic or actually be toxic to prospective investment partners. You only need to look at how private sector oversight has transformed Saudi Aramco, which I must add used to be a fully private company before the Saudi government takeover and the privatization that came later. Immediately, NNPCL is properly listed on local and global exchanges. Apart from attracting vastly higher and cheaper funding, its governance and management processes will be compelled by pressures in the market to match best practices, and the result will be vastly superior to what currently obtains. Deals can move fast when they make sense, and the opportunity space in Africa as the next major magnet for global investors have already been overplayed. All that is absent and urgently required is political leadership with the right ambition, intensity, and speed that gets it and can urge change to happen, and very quickly too. Asia Pacific markets were mostly higher, tracking Wall Street overnight after Trump postponed tariffs on some automakers. Earlier, we also saw European and Asian markets rallying as Beijing and German governments signaled fresh support for their economies. There's still a bit of uncertainty around outlook for economies and trade, with talk of more exemptions on certain agricultural products from tariffs imposed on Canada and Mexico. Well, that's all we can take on this episode of Global Business Insight. Thanks for watching. This is Bode Oshosami.